Hi there. Thanks for joining us today for this Netwealth Portfolio Construction webinar, our series designed to help you discover new investment opportunities and see wealth differently. And speaking of investment opportunities, we're delighted to have Roger Montgomery from Montgomery Investment Management join us today to share some of his for the year, and as well as his economic outlook for 2019. My name's Liam from the marketing team here at Netwealth, and before I hand over the mic to Roger, I'll just quickly run through some important housekeeping items. For the financial advisors joining us today, there is one CPD point allocated for attending this webinar. To receive this CPD point, you will need to complete the feedback survey that will appear at the end of this session. The CPD details will then be emailed to you within the next week. For everyone, this webinar is being recorded and you will receive a copy of this session along with the slides in an email also within the next week. If there is anything you would like to ask Roger today, please note the question box on the taskbar on the right-hand side. Please type in anything there and we'll save some time at the end and Roger will try and answer as many as he can. And if you wish to share anything about this webinar on social media, we ask you to please include hashtag NetwealthInvest or @NetwealthInvest. As always, the information shared today is general advice only and is not intended to be a substitute for professional financial advice. Before we get started, just a little bit about Netwealth. So a little bit about us. Nearing our 20th year, we are an ASX listed company established to help Australians see wealth differently and discover a brighter future. For investors, we provide a range of investment and superannuation solutions via our online platform. The platform can help you take control of your financial future through access to an extensive range of investment options, easy to use research tools and best-in-class technology. Some of our key features are the ability to manage your super investments using market-leading portfolio and transaction tools. That includes online share trading, access to over 300 managed funds, term deposits, pension and benefit payments, income repayments, and tax management tools. Analyze your portfolio with clarity and transparency by accessing a comprehensive range of reports and online charts. And you can also get the latest research and performance data to search and compare managed funds and managed account models, keep up to date with changes in the Australian stock market, and you can also access and view buy, sell, and hold recommendations on US securities from analysts, insiders, hedge fund transactions, and blogger sentiment. Our online platform also supports financial advisors with a wide range of financial and products and services to help manage their clients' investments in superannuation. So partner with us, an award-winning platform to start running your business the way you want to, with key features that include a market-leading advisor and client portal that is intuitive and easy to use, a mobile app to help you and your clients access key info on the go, a wide range of investment options, a suite of detailed reports that can be tailored to you and your clients' business needs, and also access to unique insights designed to help you grow your business. Now, on to our speaker. I have the pleasure of introducing Roger Montgomery, the founder, chairman, and chief investment officer of Montgomery Investment Management. He is a renowned value investor with more than 22 years' experience, and following a successful career as an analyst and public company chairman, Roger published the first edition of his stock market guide, Valuable, in 2010, becoming an Australian bestseller in just 16 weeks. So I won't take up any more of your time. I'll hand it over to you, Roger.
Thank you very much. Great to be with everyone. Okay, we'll get straight into the presentation, and throughout the presentation, obviously, if you're thinking about questions, jot them down and send them through, and we'll do our best to answer them at the end of the presentation. Obviously, I'm going to be mentioning some stocks today. Please remember that they're not a recommendation to buy or sell or do anything else with them. Be sure to seek personal professional advice. Okay, we're going to talk about, by way of background, what we think matters most to investors, we're going to talk a little bit about and go through this at a rapid rate of knots, how we achieve what we think matters most to investors. And then we're going to talk about the risks and opportunities that we see in both domestic and global markets, and finish off with very brief what we think is a sensible response to what we're seeing. There is a mountain of statistics that I'm going to go through for you. I think that the outlook is very clear. It's been clearer to me this year than at any time over the last few years. And so I'd like to share with you my views, keeping in mind, of course, that I could be 100% wrong. Economists get it wrong all the time. Investors try not to get it wrong very often, but we sometimes do. So while so far our expectations have been brought to bear, and we've seen, I guess, our hymn book playing out exactly as expected, it might be the case that in 2019 that we get it wrong. So just keep that in mind. Okay, so what are the two things that matter most to investors? Well, it's pretty simple. Everyone will tell you that returns matter, but it is also true. That the path of those returns matter as well. If I said to you that you were going to start out 2019 with $1 million and you were going to end the year with $10 million, I'm sure you'd be pretty happy with that spectacular tenfold return. But if I told you that the $1 million would have to take a path of minus 10 million first before it got to 10 million positive, some of you would say, well, no, that's not for me. So the path of the return, which is one way of describing risk, is probably just as important to many people as the return itself. With that in mind, this chart here is showing you the volatility, I guess, or that period that we saw the market selling off in the December quarter last year, the last quarter of calendar 2018. And what you can see there is that Montgomery performed best of the other managers in that period, and without the volatility of many of the other managers. So again, just addressing that we were positioned for that kind of event, and we continue to remain vigilant that that sort of volatility that we saw in the last quarter of last year is, we believe, quite likely to be repeated at various junctures throughout 2019 and 2020. So we're pleased that we're holding some cash. We're pleased that we're invested in what we believe to be high quality businesses as well. Many of you wouldn't have seen this particular chart before, but I'll simplify it. If you look at that green circle in the graph on the top left-hand side, that green circle represents the Montgomery Fund since the inception of the fund. And if you draw a horizontal line over to the vertical axis, you'll see that it intersects at about 85%. What that means is that in any month since the inception of the fund where the market's gone up, on average, the Montgomery Fund has captured 85% of that upside movement. And then if you draw a vertical line down to the horizontal axis, it intersects at 63%. What that means is that since the inception of the fund, in any month where the market has fallen, the fund has only captured 63% of that downside movement. In other words, we capture more of the upside and less of the downside. And that is important. It's about the path of returns. It's about delivering a palatable path of returns. So good returns, but with low volatility. And because we thought the market was so expensive over the last 2 years, we've held a relatively large amount of cash because we believe that the risks did outweigh the potential returns. And we think that we're still seeing that play out this year. You can see here another chart which goes from the 1st of October through to the end of December, again displaying with a few other fund managers there. And you can see once again that the way we were positioned, the idea being that we want to mitigate losses and prioritise the preservation of capital more than chasing the last few percent of returns. what that has meant is that we stayed away from the high beta, high growth stocks, the very expensive stocks that drove returns over the last couple of years, purely based on momentum. Many of these companies aren't actually generating a profit. We stayed away from those companies, and consequently, when the market corrected, as it did in the December quarter, we performed very, very well. Again, caring more about the preservation of capital than participating in returns from high risk, high beta stocks. And since the inception of the fund, again, delivering a solid return without volatility. We would have liked to have been fully invested. I should say to you that the Montgomery Fund's return in this chart has been delivered with an average of about 20% cash sitting in the portfolio. So fully a fifth of the portfolio was sitting in cash, believing particularly in the last couple of years that the market was expensive and that high quality businesses were particularly expensive. So we've held a fair bit of cash and as you'll see later on in the presentation, through that December sell-off, we've managed to deploy some of that cash. Okay, so how are we achieving this profile of returns? Trying to capture most of the upside and trying to mitigate capturing the downside. How have we achieved it to date? Well, it's pretty straightforward. What we're doing is we're focusing on three things. The first thing is a very specific definition of quality. What is quality? Well, we define it as a business that's able to generate very high rates of return on large amounts of incremental capital. So we want companies that can generate a 20 or 30% return on large amounts of retained profit. That's the ideal company for us. We also want a business that's going to be bigger in the future than it is has been in the past, or the market has misinterpreted or misunderstood its prospects for the future. So the market might believe that the prospects are much worse than they actually are. So there are two scenarios where we think we can obtain growth. And also we want a company that's high quality with bright prospects to be available at a cheap price for us. That has not been available over the last few years. And that's as a consequence, we've held a fair bit of cash. Okay, in terms of recent examples of stocks that we've either purchased or sold, REA is a business that you might have heard me speak about over recent years. We believed when we bought the stock at around $40, we believed that REA was being misunderstood by the market. Many market participants believed that that REA benefited, or somehow its performance would be related to house prices, and there was some concern that house prices would sell off, and consequently REA was available at a cheap price. But in actual fact, REA's profits and revenues come not from house prices, not directly anyway. They come from the number of listings and also the number of the price of those listings. So REA had been able over recent years to raise its prices and also generate higher revenue per user through mix shift. And when I say mix shift, it was changing the mix of the proportion of ads that were premier all ads, or the more expensive ads, versus some of the cheaper ads. And so by raising prices directly through price increases, and also by migrating its clients to the more expensive premier ads, it was able to increase revenue rather dramatically, even though total listings in Australia was declining. However, once the shares started to rise towards just above $90, we started to reduce our weighting. So you can see back in February last year, we had almost a 6% weighting, 5.62%. And then you saw that as the price approached $90 and above $90, we reduced our weighting to less than 4%. We increased the weighting slightly again as the share price dropped to $80. But again, as it rallied, we sold down to 2.4%. And as the price bounced after October into November, we sold down again, and we'd made the decision at this stage to exit the position. And we now no longer own shares in REA. Our logic there, what has changed is pretty straightforward. We think that we correctly, as many of you know, if you read the Australian newspaper where I write, or on our blog at rogermontgomery.com, many of you will know that we did correctly predict that house prices would tumble. We now believe that the sell-off could be a lot deeper and last a little bit longer than we previously thought. And what that means for REA is that they're partnering with real estate agents and probably are going to be less likely to be able to pass on the sort of price increases that would justify a $90 share price. And so we believe that there's a possibility, just as there often is in the market where prices overreact to the upside, that prices might overreact to the downside, and that'll give us an opportunity potentially to buy the shares cheaper, and we look forward to that opportunity. But we do think that it's going to be difficult, in the near term at least, for REA to pass on price increases to agents. And so analysts will probably start bringing down some of their earnings expectations for the company in the next few quarters and the next few 6-month periods. ResMed is another one that we sold out of last year. We still think it's a high quality business, albeit it could one day be disrupted by new technology. There's all sorts of Kickstarter projects and Indiegogo projects where people are coming up with novel ways to help reduce snoring and the health consequences associated with snoring. So ResMed could be disrupted. Having said that, though, there's nothing of its scale in the marketplace today. It is a high quality business and it does dominate its market, and consequently it's a high quality business. But you can see that we thought the price was getting a little bit expensive, and so we exited. Of course, we're not able to predict share prices perfectly, and the share price continued to rise after we sold, but more recently the share price has come off. Flipping over now from companies that we sold to a company that we've recently purchased, we quite like the overseas earnings possibilities or opportunities for Reliance Worldwide. They're the manufacturer of the SharkBite Click to Connect plumbing products, which are going absolutely bananas over in the United States. They're selling through double-digit increases in terms of volume and revenue, and we're delighted to see that. And you can see we did the due diligence on the stock earlier last year, but the share price above $6 was too expensive, and as the share price came down towards $4, that became much more palatable to us as value investors, and so we've I guess established a position in that company, and any further price weakness, if it transpires, will be an opportunity for us to add to that position. Okay, so moving on now to what's going on in global and domestic markets. Let's start with an understanding of the risks associated with investing at the moment. I just want to talk briefly about why we think now is a really important time to have some cash in the portfolio. Normally, having cash, as I've painfully learnt, having lots of cash for a long period of time does hurt performance. We could have had much better returns than even the returns we generated if we'd invested that 20% cash that we've been sitting on average over the last 2 years. But cash is an option over lower prices without a strike price and without a time to expiry. So there is an expense associated with carrying cash. However, when when prices are expensive, and if you particularly believe that prices are going to be cheaper, then having some cash is not a bad idea. And this particular chart here demonstrates it through an understanding of what is called sequencing risk. So what we've got here is an individual who in 1979 invested $148,000, half of which went into shares and half of it went into bonds. They then commenced drawing $10,000 out each year, and that was indexed to inflation, so that by 2011 they were withdrawing $40,000 a year. Now the dark blue dashed line is their account balance over that period of time between 1979 and 2011. The light blue line is the account balance just changing the order of the returns and reversing them. So in other words, the 2011 return in markets became the 1980 return for this investor, and the 2010 return became the 1981 return. So what you can see there is just by changing the chronological order of the returns, the investor ran out of money 10 years earlier. In other words, getting it right at the start really matters. You really don't want to have a bad investment performance early in your retirement. So this is called sequencing risk. And because markets have been expensive, because there are a lot of sources of volatility this year and next year, we think it's right to be invested with a manager who has some cash and the flexibility to both protect or preserve capital and take advantage of lower prices if they transpire. If you're fully invested in a high beta portfolio of growth stocks that are momentum based, that aren't earning profits, well, there's a very real risk of large negative returns over the next couple of years. And because of that, and remember, that's just one man's belief or one firm's belief, but because of that, we believe it's wise to be invested in some cash or with a fund manager who is at the coalface and managing to allocate strategically or tactically cash to the market. Okay, so why do we think that's important? Well, we think most stocks are expensive at the moment. They're on the expensive side of fair value, the overvalued side of fair value. But that doesn't mean that all stocks are expensive. We still think there's some value in markets. And you saw in that chart earlier, we recently added Reliance Worldwide to our portfolio. And we did that when we thought the share price was cheap. Now, recently, you've seen the share price of Blackmores decline substantially. You've seen the share price of Bingo fall 50%. AB Jennings came out recently and their profit for the half declined 90% compared to the previous prior corresponding period. We've seen a lot of companies fall on difficult times, and we're waiting for those opportunities where they were previously expensive. We're waiting for them to become cheap again. And so we think there's some value out there, and we think this year there'll be more value in the marketplace. But in aggregate, markets are expensive at the moment. That's also reflected in this chart here. Now, this is Robert Shiller's CAPE ratio, which is the cyclically adjusted PE ratio for the S&P 500. You might be asking, well, why does Roger use the S&P 500? Well, one is we can get the CAPE ratio for Australia, but what we know is if there's any kind of correction in the US market, what we know is that the correlation with other markets globally increases and the variance reduces. In other words, they all tend to fall together. So that's why we're having a look at what's going on in the United States with this ratio here. And what you can see is that this cyclically adjusted PE ratio for the S&P 500 is sitting at about 29.5. In fact, it's a little bit higher than that at the moment. It's about 29.75. If you then cast your eye all the way back to the start of the graph over on the left-hand side, it goes all the way back to 1880. And what you can see is that there were only two periods where the ratio was this high or higher. And that was just before the Great Crash in 1929 and in 1999, early 2000, just before the tech bubble burst. In other words, the market is the third most expensive that it's been. Now, some of you will be looking at this chart and saying, hang on a sec, Roger, I know what this CAPE ratio does. It looks at a 10-year average earnings number. And if we go back 10 years, that takes in the first quarter of 2009. And in the first quarter of 2009, Dow Jones and S&P 500 earnings fell about 25 or 26%. So it's capturing a skewed low earnings number, which might make the PE look quite high. Well, in actual fact, if you do a simple experiment and just drop off that 2009 earnings number and add in the expected second quarter number for 2019, then what you find is the ratio is still around 29 and making the market expensive. So what does this mean? Well, the ratio doesn't predict, by the way, crashes. It's no good at doing that, and Robert Shiller will tell you that. What it is very good at doing is predicting the next 10 years average return. And the numbers that you can see there in the blue represent if you'd bought the index at that point. This is the subsequent annual return for the next 10 years. So it's an annual return for the next 10 years with dividends reinvested. And what you can see is when you buy the index, when the ratio is expensive, the returns are quite low. And when you buy when the index is cheap, the returns are quite high. So even if a crash doesn't eventuate, if you were to buy the index today, then there's a very high risk of poor early returns. In other words, your sequencing is at a dangerous point if you're retiring today. You're locking in a low return, and you might be locking in a low return with a lot of volatility, which obviously could be damaging to your wealth. Why is the market so expensive? Well, there's still a lot of this going on at the moment. What is this? Well, as a bit of a fun exercise, I decided to divide the market capitalisation of all the major car manufacturers by the number of cars they delivered last year. And what I found was if you wanted to buy Ford Motor Company outright, you wanted to buy the entire business, you'd be paying about $5,500 US per car you delivered last year. If you wanted to buy Toyota, you're paying about $12,000 per car delivered. If you want to buy Volkswagen, it's about $13,000. BMW is about $21,000, and Mercedes-Benz is about $29,000 US per car delivered. But if you wanted to buy Tesla, and to put Tesla in perspective, Ford delivered 6.6 million cars last year. Tesla delivered about 160,000 cars last year. So if you want to buy Tesla, the company, you're paying about $390,000 per car delivered. It is a far cry from every other car manufacturer in the world. In fact, even if Tesla ramped up production tenfold to 1.7 million cars, which is what Mercedes-Benz delivered last year, you'd get to a multiple like Mercedes-Benz, but you wouldn't make any money from the shares. So there's a lot of that going on. Netflix, Twitter, we're still seeing a lot of expensive high-tech companies that aren't making money in the United States at very expensive multiples, and that's why the US market is so expensive. Somebody else thinks the US market is expensive, and that's Warren Buffett over at Berkshire Hathaway. This is a chart of the cash balance at Berkshire Hathaway, and it needs to be updated, of course, because at the moment, cash is about $135 billion US. To put that in perspective, that is about 26%, 25 or 26% of the market capitalisation of Berkshire Hathaway. But of course, Berkshire trades at a premium to its portfolio value or its net tangible assets. And in actual fact, it's about 37%, the cash balance that is about 37% of the portfolio value of Berkshire Hathaway. So almost 40%, more than a third of the portfolio is cash. So while Warren Buffett often appears on CNBC with Becky Quick talking about markets being great and markets being fine and not expensive, and you know the US is a great place to invest over the next 20 or 30 years, his biggest single position is cash. And that's telling you something. I think we should pay attention to that. So what else has been happening? Well, of course, in January this year, the US Federal Reserve at their Federal Open Market Committee meeting backed away from rate hikes. They said that they'll be patient before making any further moves. And what was interesting is that they said they were prepared to adjust any detail of completing balance sheet normalization, if you like, interest rate increases. They were prepared to adjust any of those details in light of economic and financial developments. In other words, the Fed has your back. If the US stock market falls, don't worry, the Fed's there to rescue you. What they did say, though, is that they'll continue their quantitative tapering until the balance sheet is substantially smaller. So while they're not going to increase interest rates at the short end, they're going to continue tightening their balance sheet, or if you like, selling bonds back into the market, or not buying more of them as their bond portfolio matures. So what this is telling you are two things. Number one is they believe that the US economy is actually weaker than what the market believes. They think that the economy is weakening so much so that they're not willing to raise rates anymore. And secondly, and perhaps more importantly, they're continuing their quantitative tightening, which means that they'll continue supplying bonds to the market, whereas previously, as you can see in this chart, they were increasing their balance sheet. And when you combine the Bank of Japan, the Bank of England, the European Central Bank with the Fed, up until the middle of 2017, cash was being injected into the market and bonds were being removed from the market. But now the reverse is happening. Bonds are actually being removed from central bank balance sheets and being sold into the market, and cash is being withdrawn from the market. Now, what does this mean? Well, it actually means that bond interest rates, sovereign bond interest rates, particularly US Treasuries, are becoming more attractive. And if they're becoming more attractive, that means that investing in higher risk, high yield or CCC rated bonds, or investment grade, the lowest investment grade BBB rated bonds, is becoming less attractive. And if it's less attractive to invest in high yield corporate bonds and relatively more attractive to invest in treasuries, then what's going to happen is people are going to sell, investors are going to sell their corporate bonds, and they're going to invest in treasuries, which is of course going to push the bond price down for corporates and the yield up, meaning it's going to be more expensive for corporates to fund themselves through debt in the future. And that's a big issue in 2019. Why? Because we have a credit market record level of CCC rated bonds due to be refinanced this year, about $490 billion US, and a similar amount next year. It's also true that when you look at BBB rated bonds, which is the lowest investment grade, and you look at them on a debt to EBITDA basis only, half of them are should be rated high yield or CCC rated, not BBB rated. So there could be a wave of downgrades this year as well, and that could increase volatility. So I think the fact that we've got an expensive market, I think the fact that we've got some very expensive tech stocks still in the market, I think the fact that Buffett has got a lot of cash, and I think that the Fed is changing its position on its balance sheet, are all potential sources of increased volatility this year, which we see as a terrific opportunity. We think volatility delivers lower prices deliver higher returns. The lower the price you pay, the higher your return. And as we saw, for example, with Blackmores, Bingo, and several other stocks, Cochlear, and also CSL, we think lower prices are exactly what investors need to generate higher returns. Okay, here's another potential source of volatility. Again, it's just a coincidence perhaps, but it's one worth looking at. The light blue line is the S&P 500. The dark blue line is the S&P 500's earnings. If you look closely back to 2011, you'll see that there was a period where earnings flatlined, and that caused some volatility in the market. You'll also note that through 2014, 2015, we saw earnings flatline again and decline a little bit. That was a source of volatility, or coincided with volatility in the market. And you can see now that earnings are also under pressure, and that is causing some volatility. We think that those earnings will continue to be under pressure, and so we think the S&P 500 will be volatile, and that will lead to volatility in our local market as well. So what is actually happening in US earnings? And forgive me for not updating this, I've been pretty busy at the moment, but what we know is more than 50% of US companies have reported, significantly more than that now. And a significant proportion of those companies that have reported gave positive earnings per share surprises. Now that's a good thing. However, what we also know is that the earnings guidance of the majority of companies, or a larger number of companies, has been negative. In fact, so much so that Q1 EPS growth estimates are now sitting at minus 0.9%, compared to a 6.7% increase, which was what was forecast in the September quarter last year. So back in other words, I'll reword that. In September last year, analysts thought first quarter earnings for 2019 would be growth of 6.7%, and it now looks like it's going to be a decline of about 1%. So in other words, earnings momentum is falling faster than what analysts had previously expected. Their expectations are declining with it. And now in the first quarter, companies' guidance is declining as well. So we think that the sort of conditions that produce volatility in the S&P 500, we think those conditions are going to exist in 2019. And that, on top of that, is margin pressure for companies. So earnings are declining. There's also margin pressure. I mentioned earlier, corporate bond rates are increasing. Their prices are declining. You can see the price changes on this chart here. An update of this chart would actually show that prices have fallen even more up until Christmas Eve and then bounced back to the levels that you can see in this chart here. Nevertheless, what we're seeing is bond prices falling and interest rates increasing. If that's going to continue, that means margin pressure for US companies and therefore more negative pressure on US corporate earnings. Zooming out from the United States and looking at the globe, what we now know is that global industrial production is in decline and is in fact has been declining for about 13 months. Keep that 13 months in mind for a moment. It's important to know that the current downturn that we're seeing is the third since the GFC, but there's been 20 downturns since 1956 and only 8 led to recession. So what I don't want to do is panic people into thinking we're going to have a recession in the United States, although there are plenty of Cassandras out there saying that there will be a recession. What this is saying is that we are definitely past peak growth. Okay, so we're past the point where growth was growing, the economies were growing at their fastest rates, and the rate at which they're growing is now declining. Now, of those 20 global periods of slowdown, only 8 led to recession, so there were 12 others that were, let's call them mid-cycle downturns. What's interesting about those mid-cycle downturns is they lasted an average of 18.5 months. And if this is a mid-cycle downturn that we're in now, well, just to go to the average period of time that we're in that downturn, we've still got another 5 or 6 months to go. Okay, so keep that in mind. Why should you keep that in mind? Well, when economies are slowing, people start thinking about risk a lot more than when economies are expanding. When economies are expanding, everyone climbs a wall of worry. They don't worry about the risk. They don't worry about volatility. They just think it's all good. But when the economy's slowing, then negative surprises tend to be focused on much more acutely. The IMF World Economic Outlook is now projecting US growth of about 2.5%, whereas back in 2018, the expectation was 2.7%. So US expectations are for lower growth, and you can see the IMF expectation for 2020 is a decline in growth from 2.5% to 1.8%. That's over on the far right-hand side. And you can see the IMF is also consistently or progressively reducing its expectations for global growth as well. And in fact, Lagarde from the IMF came out and she said that she's very, very worried about China's influence on even these growth rates. So we're past peak growth. It's not a contraction. We're not going negative, but we're definitely growing at a slower rate. The People's Bank of China and the Fed are now being referred to as the plunge protection team. They've got your back, so you've got nothing to worry about. The only problem is, of course, that the market has rallied significantly in January. And so the market, I believe, is now factoring in a good outcome. So it's quite likely that any negative surprises are going to be a shock. And so that could be another source of volatility. And remember, Singapore is a very good bellwether for global trade. And GDP just came out at 1.6% for the fourth quarter, versus expectations of 3.6%. So it does look like there are very real risks to the global economic outlook, and further downgrades are possible. Just remember, I'm not saying that there's any correlation between stock markets and the economy. In fact, there isn't. All I'm saying is this is another potential source of volatility, and this slowing economic growth picture, which is a source of volatility, I'm hoping does deliver some volatility for us, because if it does, and we're already seeing it in the first half results for Australian companies, it delivers lower prices. And if we get lower prices, it means we can take advantage of that cash that we've got in our portfolios. There are many fund managers that need to be fully invested at all times, and they don't have the luxury of being able to add to portfolios with new investments when prices are lower. And that's why we've positioned ourselves the way we have. We're looking forward to this period of volatility with our cash. Okay, China obviously matters a lot to Australia and to the world. 30% of our exports go to China. President Xi Jinping recently warned of serious dangers. It's quite unusual at the forum that he spoke at to talk about the economy, but that's precisely what he did. And he warned of I think he called them, they didn't call them black swans, they came up with their own term. I can't off the top of my head remember what that term is, but China came up with their own version, their own copy of a black swan. And Xi Jinping said that there are very serious dangers and that officials need to be attuned to these black swan events in China. Malaysia cancelled a rail project worth $20 billion. The Chinese population shrunk for the first time last year in 70 years. And if you believe the numbers, the country is now growing at 6.4%, which is the slowest since the GFC. Capital Economics, which is an independent economic research house that I have a lot of respect for, they believe that over the next decade, Chinese growth will continue to slow. It'll grow at as little as 2% a year within the next decade, or it will be growing as slow as 2% a year in the next decade. And they went on to say that China won't be the biggest economy in the world in the foreseeable future, as many people predicted they would. What's important to understand is that they have incredible amounts of debt. Most of that debt has been used to finance fixed asset investment, which still represents about 44% of GDP. Now remember, if you go back to 2013, 14 and 15, the economy was slowing as the government tried to transition the economy from a fixed asset investment-led economy to a consumer-based economy. That failed miserably. The economy slowed down dramatically in 2015, and so the People's Bank of China was forced to reflate with a huge credit injection. At the moment, the expectation is that as the economy slows again, they will do that again. But there are risks. You can only do it for so long, and we'll see in a moment what those risks are. For Australia, for BHP, for example, you can see that the imports of iron ore are slowing down. You'll note also that Chinese production of iron ore is slowing down even faster, and that's because they want to clean up their environment, so they're importing higher grade iron ore from places like Australia, which is obviously good for BHP. But I note that BHP announced in their results that they're not planning on increasing production in light of recent increases in the iron ore price. And that's telling you that they might think that the iron ore price increase is not sustainable. You can see here that China is reducing its imports and reducing its production. So that's something to keep in mind and reflects the slowing Chinese economy. Another reflection or another measure of a slowing Chinese economy is vehicle sales. In 2018, they declined for the first time in a very long time. And in fact, in January, Chinese vehicle sales fell at an increasing rate. So the rate of decrease of vehicle sales in China is increasing. And all this has led to Kenneth Rogoff. If you haven't read his book, This Time is Different, 8 Centuries of Financial Folly. Let me give you the summary of the book. The summary is this: in every financial crisis over the last 800 years, 4 things have existed every time. Number one, there was a debt boom, usually accompanied by an asset boom, and primarily that was property. And then there was an economic slowdown as well as a current account deficit. So those 4 things always existed when there was a financial crisis. Now, they also existed during periods where there was no financial crisis, but we know wherever there was a financial crisis, these 4 things happened. So keep Australia in mind when you think about those 4 conditions. But Kenneth Rogoff, the author of the book, who's also a professor of Harvard and regarded globally as the expert on financial crises, he was at Davos in Switzerland during the World Economic Forum in January this year, and he said these things that you can see quoted on the screen, and that is, China is in the grip of a dangerous downturn. Quote, I fear this really could be it, their Minsky moment, and a Minsky moment is where an economy collapses under the weight of its own debt. And then he said again, I fear this will be the 3rd leg of the debt supercycle. And what he was doing there was referring to the subprime crisis as the 1st leg of the supercycle, the Greek crisis and default as the 2nd leg of the supercycle, and now he thinks China might be, and he fears it might be, the 3rd leg of the debt supercycle. Australia cannot afford for that to happen, not where we are as we'll see in a moment. China still has room to manoeuvre, but they can't escape the forces of economic gravity. The reality is the debt must reach a ceiling at some point. Okay, for Australia, well, the good news is we created almost 300,000 jobs last year. Our unemployment rate is at 5% as of December, which is near full employment. And back in November, the RBA said that 2018 GDP would be about 3.5%. We're about to see a budget surplus, I think, and we've gone 27 years without a recession. So a lot of people say it's all good in Australia at the moment. However, I think a lot of this is being offset by a shocking drought and now floods in Queensland, retreating house prices, which we'll talk about more in a moment, evaporating consumer confidence, we'll talk about that in a moment as well. And while unemployment is declining, GDP is in fact slowing. In fact, at the end of the 3rd quarter, Australian GDP was only 2.8%. And now what we know is that the RBA has reduced their forecast for 2019 from 3.25% to 2.75%. And of course, we've got wobbles going on in China and some anxiety about the election. But let me tell you this, the reason why we're seeing falling retail sales, falling foot traffic, falling car sales, falling house sales, the reason why we're seeing all this is I believe Australia has entered the great Australian deleveraging. So we've gone from the GFC 10 years later to the GAD. So the great Australian deleveraging. And what is that? It's where credit growth slows or grows a lot slower than GDP. And that leads GDP down. And think about it this way, with people's house prices falling, what are they going to do? They're going to tighten their belts and focus more on getting that debt down. That's all that's happening. And that's why we're seeing the things that we're seeing at the moment, which we'll talk about more now. So obviously we've seen tighter lending from the banks following the Royal Commission and David Murray's financial system inquiry. Fewer loans are being approved. There's delays to those approvals. They're taking longer to be approved. And if you are approved, you get less money. So the rug's being pulled out from buyers. There's simply less buyers for property. Consequently, we're seeing the biggest house price falls in 4 decades. Sydney's recorded its steepest declines in 20 years. We're seeing lower domestic and foreign investment. We'll talk about that in just a moment. And housing supply's gone up. In fact, we've seen listings in Melbourne jump 42% compared to December 17. Canberra was up almost a quarter. Sydney advertised houses for sale up 22% as well. And nationally, listings rose 8% in December on a year earlier. So think about that. You've got less foreign buyers, you've got less domestic buyers, you've got less investors, you've got less interest-only borrowers, and you've got supply going up. Prices can only go one way. And if Labor wins, it'll be a lot worse. So I'm not going to advise you on who to vote for, but if I was going to advise you, I would say don't vote Labor. Australia's property plunge is actually accelerating. We're seeing, for example, fewer investors in the market as well, harder for investors to get loans. So investors are backing off. They're also backing off because prices are falling and they don't want to catch a falling knife. So you can see the proportion of all new mortgages that are investor loans is declining. You can see here from APRA's table, the interest-only loans approved have plunged 55% from March 2017 quarter, where $32.3 or $4 billion worth of investor interest-only loans were approved. In the September quarter of last year, only $14.4 billion of loans were approved. That's a decline of 55%. And I expect when the December data comes out, and it might have actually just come out in the last few days, when the December quarter comes out, I think we'll see even further declines. The red line represents new properties, the black line represents established properties, and what you can see is the proportion of foreign buyers of new and established properties actually declining. So again, just showing you that the rug is being pulled out from the property market because buyers are deserting the market or can't get financing. This chart here, I've now got an update for you as at today. You can see these are Foreign Investment Review Board applications, approvals. And so what you can see is back in 2015, 2016, $72 billion of applications were approved for housing. And what you can see is in 2016, 2017, that number dropped to 25 billion from 72 billion. And I can tell you 2017, 2018, that number has dropped to between 11 and $12 billion. So it's halved again from the 2016, 2017 number. So we clearly are seeing, and this is a global phenomenon, not just in Australia, but we're clearly seeing foreign investors desert the market. Don't feel under any pressure from real estate agents to pay whatever price they're asking for an apartment in Australia at the moment. Offer a lower price, you might just get hit. We also know that sales of new houses has fallen dramatically, and this is the actual number of houses sold. And what we can see is we're back to 2001 levels. So at 17-year lows at the moment. This has serious implications for the number of couches that are going to be sold in the next 12 months, the number of fridges, the number of freezers, the number of plasma televisions. They don't have plasma televisions anymore, do they? They're LED televisions. So, you're going to see less houses being furnished because less houses are being built and purchased. And we saw also with Villa World, for example, and AV Jennings. If I look at the Villa World numbers, Villa World reported 440 lot sales in the first half of 2019, and that's down from 963 lot sales in the second half of 18, and 715 from the half before that. So we're seeing companies are reporting less houses being sold. So that's going to have implications for Nick Scali, Beacon Lighting, Harvey Norman, JB Hi-Fi, and the good guys. Their numbers to date might look pretty good, but in the next 6 months, we're going to see a very different picture. Okay, we'll race through some of these slides because I don't want to run out of time. Foot traffic to stores, massive declines in foot traffic, down 8% in December year on year. And in the first couple of weeks of January, we saw the foot traffic down again, 3%, compared to the first 2 weeks of January 18. And I should point out that the first 2 weeks of January 18, they were down 10% on 2017. So this is a function, there's some cyclicality to this. In other words, it's a function of the deleveraging that I talked about earlier, people focusing on their debt, record levels of household debt. But there's also a technology element to this, people buying online and going to stores less and less. So that's something to keep in mind if you were thinking about buying any of the retailers at the moment after their share prices have fallen. It might be a little bit too early just yet. Retail sales in Australia declining precipitously. To put it in perspective, household goods fell 2.8% in the fourth quarter. That's significant, 2.8%. If you annualize that, 2.8% times 12, you're looking at almost in compounding, you're looking at between a 36 and a 40% annual decline in household goods sales if it continues at that rate of decline as we saw in the month of December. So that, just keep that in mind. Still declining, no respite yet, and we really want to see some sort of stabilisation in those numbers before we think that the worst is over for retailers in Australia. So I think there's weakness ahead for furniture, hardware and white goods. Keep in mind, Metcash, 25% of its earnings come from Mitre 10 and home timber and hardware. Bunnings, that was 27% of EBIT for Wesfarmers, but post the demerger of Coles, once Coles has spun off, 40% of EBIT will be Bunnings for Wesfarmers, so keep that in mind. Harvey Norman, 40% of earnings is driven by furniture and appliances. If we look at Mirvac are now targeting lower lot sales. We're also seeing the same from Villa World and AV Jennings. AV Jennings half-yearly net profit after tax was down 90%. Their revenue was down 40%. So this is really happening. If we talk about Beacon Lighting, I'll come back to this chart in just a sec. Beacon Lighting here. If we talk about Beacon Lighting for a minute, they reported 4.8% like-for-like sales, but they opened 3 new stores. Therefore, their adjusted like-for-likes is actually only up about 0.5%. And January was weak for Beacon. So we're seeing difficulty in the building space and the renovation space. AGL came out with their full year results earlier last year, after the full year results last year, and they reported a 22% jump in bad and doubtful debts. In other words, people are already struggling to pay their gas and electricity bills. Matt Common from the Commonwealth Bank, he said expect arrears to rise. And Genworth, which is our non-selective mortgage insurer, they said delinquencies are up in all states. These companies here, Beacon Lighting I've just talked about, Nick Scali, I've got there as well, Nick Scali, Anthony Scali at his briefing over at Macquarie Bank after the half-yearly results, said, look, the numbers were good, but he also talked about the future, and he said, we are going to preserve prices rather than volumes so that we come out the inverted commas other side with our brand intact. What does the other side mean? It means he believes we're entering something. So those conditions that I talked about, I think that's front of mind for people like Harvey Norman and Nick Scali and Bunnings and Beacon Lighting. So we really want to be careful about venturing too early into the retail space in Australia. Okay, so what's a sensible response to all of this? Well, one of them I've just given you. You really want to keep your powder dry. Don't want to jump in too early, even with good retail stories, because remember, the longer term picture, the online threat remains, and I don't think we've actually seen Amazon really ramp up. What we've seen overseas with Amazon gives us certainly reason to pause and reflect and not think things are great now for Australian retailers. I don't think Amazon has tightened the screws anywhere near as tightly as they possibly can, and as we'll see in future years. Okay, so our response has been this. We've been positioned for that December quarter sell-off. We've believed that prices were expensive and that a sell-off was possible. And as the market has gone down in the blue line, you've seen that our bank balance of cash has declined as well. In other words, we've been deploying cash. But what you can see is as the market has rallied in January, we've stopped deploying the cash. We've continued to hold cash. We've paused on our purchases. And hopefully, if prices decline again, we'll take advantage of those lower prices by deploying more cash. And finally, we've steered clear of, I know you can see there some of the sectors, you'll see that consumer discretionary's got quite a high weighting. In fact, our consumer discretionary weighting is 0. The reason why that's showing a weighting is it's reflecting the REA weighting that we had and we don't have anymore, and it's also reflecting a weighting in SEEK. They're considered consumer discretionary stocks, but in actual fact, they've got nothing to do with discretionary retail. So we're not in energy either. We're not in materials. I talked about China. We're not in real estate for reasons that are obvious to you now. So there are our responses, and I'm looking forward to answering your questions.
Yes, thank you, Roger. Yeah, great discussion and chat there. Listeners, we hope you found that valuable, and we hope you got some insights into what to potentially avoid in the upcoming future, and hopefully found some opportunities in there as well. Apologies, we're running a little bit over time, but yeah, all good stuff from Roger, so can't complain. We're gonna jump into some questions now. So what I'll do is I'll open the questions, Roger, and you can just race through them as quick as you can. As I'm opening, Roger, I'll kick you off with a question that was your thoughts on gold in your head, even if you wanted, even through an ETF.
Look, if you believe that volatility is going to increase, or if you believe that there's any kind of increase in chatter about a financial crisis, which I personally don't believe, but if you do believe that, then obviously gold does well. Remember, gold is a bet against, it's a bet on fear. That's all it is. Gold doesn't earn an income. It's not going to be more valuable in 100 years' time than it is today. It's just a bet on fear, and it's a bet on the increasing fear of other people. So if you think that fear is going to increase, then gold is a hedge. But trying to predict that is very hard to do.
Yeah. Got another one coming up. What's your view on the Australian dollar and the US dollar?
Yeah, look, I think there's a very real risk that the Australian dollar falls, that the property market becomes much worse than what we're currently experiencing, and that puts some pressure on the balance sheets of banks, certainly on their credit growth, and consequently foreign investors are less inclined to invest in Australia, and so we might see the Australian dollar fall. The only caveat to that is, I think a lot of what I've talked about is well known. Maybe people aren't as concerned as I am, but if they know what I know, the Aussie dollar, I'm surprised, isn't lower already. Maybe it's just a matter of time. I did see another question there. Somebody said, why would Labor make it worse? I suspect that's coming from a Labor voter. Look, quite simply, the changes to negative gearing that are being proposed would be negative for real estate prices, and that's why I think house prices would fall even more than I expect under a Labor government.
Yeah, I'm going back to, we got a good question here. Yeah, where do you see Australian interest rates in 12 to 5 years? 12 months to 5 years, sorry.
Yeah, look, that's almost predicting interest rates is a mug's game. We're not going to do that. We want to own businesses that are going to do well no matter what the interest rate is. I don't think that there's pressure on interest rates to rise by central banks. However, that doesn't mean that mortgage rates won't rise in Australia. If funding costs for Australian banks go up, as bond rates increase, for example, then you could see funding rates for banks go up rather, and consequently mortgage rates go up, and that would put a lot of pressure on households. The mortgage rate increases that we've already seen have done a lot of the RBA's work for them, so they don't need to raise rates. The RBA doesn't need to raise rates. So that's the answer to that question. I'm not going to try and predict. I think the bias is to the downside in the short term rather than the upside, and that's now being discussed or reflected by the RBA as well. I did see also a question there about healthcare stocks. Do I think they're immune? Look, in theory, yes, you would expect healthcare stocks to be immune. But remember, in Australia, where do you get exposure to healthcare? Hospitals and private insurance, for example. And there's some legislative changes that need to occur to really make the runway much clearer for hospitals and for companies like Medibank Private. We've got investments in both private hospitals, Ramsay, and also Medicare Private. We do believe that the runway will clear, and in the long run, it will be incumbent on the government to incentivise people to be on private health insurance. And we also believe that a functioning and healthy private health insurance sector is vital for the government's balance sheet and budget. And so we think that will clear. But those issues have affected prices in the short run. And so even though while we think they might be immune to a recession, it doesn't mean that their share prices can't go down.
Thanks, Roger. And you mentioned banks before. Have you got any thoughts on the big four at the moment?
Yes, we do. We think that we're already saw in their recent trading updates and results, revenue growth is almost non-existent. So credit growth is really starting to slow down. Now, this is important to understand, because if credit growth is growing at a slower rate than GDP, you have what's called a deleveraging. And deleveragings tend to cause a lot of volatility in asset markets. And deleveragings mean that you're going to see a lot less retail spending. So what do we think for banks? We think the banks look reasonably priced if there's no recession. If there is a recession, then all bets are off. Now, I'm not calling a recession. I still think we're growing. We're growing at, maybe 2.5% this year. I still think we're growing. We're not going backwards, but we are growing at slower rates. So in that scenario, the banks are fairly priced. They're not cheap. They're about fair value. But in that small percentage chance of a recession, then the banks would fall a lot further. So that's my summary there.
No worries. We might just stick to one last question. So, Roger, what sectors are interesting you at the moment, whether it's Australian or overseas?
Yeah, look, we like some of the mid-cap companies that are earning money overseas in foreign currency. So, for example, I mentioned Reliance Worldwide. Another one that I'll mention is a company called IDP Education. Now, please don't rush out and buy these companies. We own them. So if you rush out and buy them, you're benefiting us more than you. Do your due diligence. Tomorrow we could sell these stocks because we've changed our opinion on them. So please keep that in mind. But IDP Education, we think, has a long runway for growth. We think there are a lot of foreign students, particularly in Asia, that want to be educated in the Western system, and IDP facilitates that, and they're earning a lot of money off overseas. So there's a couple of examples. So think about, there's a lot more than that, by the way. There's Altium, there's Appen, there's A2 Milk, there's so many companies in Australia that are in that mid-cap or small-cap space that are earning money overseas. Some of them are very expensive, so I wouldn't touch them at the moment. But that's the area where I think there's a lot of potential, a lot of opportunity.
No worries. Well, thank you again, Roger. Sorry to everyone who's asked questions and we didn't get to them, but thank you for that. Again, Roger, thank you for the fantastic insight, all your honest thoughts as a first home buyer. I hope those prices keep falling.
And what we did last time, look, for all of you who, I hope you don't mind, for all of you who've asked a question and haven't had that question answered, I'll take the time later this week to answer those questions, send them back to the guys here at Netwealth, and we'll send them out to you.
Yep, we'll put them on the webpage and we'll include it in the post-webinar email, so that's fantastic. Listeners, thank you for joining us again. Just a few things from our end just to wrap up before we go. A reminder to you, the financial advisors still on the line, that to receive your CPD point, please complete the feedback survey, which should hopefully appear at the end when we close the session, and it will be emailed to you within the next week. This session is also being recorded, and the slides and this presentation will also be emailed to everyone who attended or registered within the next week. So please keep an eye out for that. Investors will also include links in this email. Investors, you'll be interested in our compare funds and model page. This is where you can find the Montgomery fund details. Also view that now by going to the Netwealth website. Under the personal section, resources and tools, you'll find the compare models and funds page. We've also got our investor podcast series where we pick the brains of wealth management professionals to hopefully uncover some key insights and investment opportunities. And we're about to record one with Roger here, so keep an eye out for that one. Financial advisors still on the line. Our 2009 Advice Tech survey is about to open, so please keep an eye out for that email. We would love you to participate and help us out with that. And as always, saying thank you, you will receive an early access to report. And we also have a CPD advisor webinar coming up in a couple of weeks, with Dante DeGori from the FBA, who will be giving his thoughts on the findings from the Royal Commission and what they will mean for your business. Finally, for everyone, if you're interested in supporting financial literacy in schools, we will be including a link to refer a teacher to Banker. That's just an online platform used in schools that provides an online hands-on environment for students to get curious, creative, and ultimately confident with money. Netwealth, we're committed to sponsoring 15,000 students, so refer a teacher to improve your kids' classroom financially. All on us. Thank you for joining us. We hope you enjoyed, and we hope to see you next time. Thank you.